Welcome back to another market update. This week, I want to cover some things that are going to happen later this week. This is a big news week for the BLS jobs report and the ADP report 2 days earlier on Wednesday. So the BLS government report is on Friday, and on Wednesday is the ADP report. But before we dive into that, let's talk about what happened last week. Last week was a little bit interesting. We had Thursday was supposed to be a big day, right, with the PCE, the Fed's preferred measure of inflation. So that measures consumer expenditures over the entire country on Thursday. And the numbers came in flat year over year. So basically about the same, essentially, as a month before. The market didn't react much. Rates didn't react much. It just kind of was meh. But what happened the next day is really what made things move. So Jerome Powell and other Fed members started talking, especially Jerome Powell, the chair of the Federal Reserve, started talking about basically what they've done. He was taking some victory laps, actually, in some of the things that he said and minutes that were released of things that had been said in meetings. I just want to go over that. And what happened is interest rates improved even more, a little bit more, right? So we had pricing improve a bit more, enough to maybe affect long-term interest rates by about 1/8% better than they were Thursday or Wednesday. So that was pretty significant. So let me just show you some of these things. It's kind of interesting, these comments that Jerome Powell made. Here's what he said on last Friday. He said, the forcefulness of our response to inflation also helped maintain the Fed's hard-won credibility, ensuring that the public's expectations of future inflations remain well anchored. So he used the term hard-won credibility. Well, hard-won because they kind of lost credibility in 2021 when they didn't increase overnight lending federal funds rate as quickly as they should have and caused some problems, right? That caused inflationary problems, and now they're trying to knee-jerk react and correct all this. So yeah, they needed to regain credibility. Hopefully they're doing that a little bit, but I don't know. Fed's never really had a lot of credibility in the eyes of most of the country, especially those that are business owners, et cetera, that are trying to make things work, and even those that are homeowners, right? It's really hard to know what to do and to plan for your future with your family when interest rates spike up and double, right, in 6 months. It's kind of tough to plan for that. So yeah, they need some credibility. He said, having come so far so quickly, the FOMC is moving forward carefully as the risks of under and over tightening are becoming more balanced. Okay, that to me is Fed speak for, we don't know what to do next. We don't know. We're just going to follow the data, which is kind of what they've been doing already, and play it by ear every month when we meet. Because so far they're noticing that, of course, these rapid increases in interest rates that have occurred across the economy are starting to have ripple effects and could push us into recession if we're not already there, and affect job stability and job markets and everything else. But they're also watching inflation data to make sure inflation continues to go down. The problem is, will it go down? I don't know. Depends if we have enough supply, right? We might have a supply side issue right now. We have plenty of demand. Demand has diminished some, but supply is also a little tougher with geopolitical risks and upheaval in various areas. Supply chains aren't perfect, right? They're not as good as they were a couple of years ago. So we'll see. But that is Jerome Powell's comments, and that caused mortgage markets to improve on Friday. They liked that. The 10-year Treasury yield dropped even more. And then today it's kind of balanced out. We got some profit taking. So it swung back kind of the other direction, kind of gone the other direction from Friday, erasing a lot of those gains. But here are the market odds of what market movers. So there's actually a futures. I don't know if it's the futures market actually participates in a lot of predictive types of, they're not games, but predictive types of investments, if you want to call that, speculative investments, speculation. So here is the futures market speculation on the market odds that the Federal Reserve will cut rates and when. If you recall, I showed you the same chart the last couple of weeks. The last time I showed you it, though, May was when it was over 50%. Now, as you can see, we're at March, where it's over 50% odds that the Fed will start cutting rates in March instead of May. So that's pretty dramatic change of sentiment in the markets in general and among those who are market participants. We'll see what happens. A few weeks ago, they said, yeah, they'll start in May and the Fed will cut rates 4 times. Now they're saying, it'll start in March and the Fed will cut rates 5 times. Now, are these guys, is the futures market ever correct, ever accurate? No. It's not. It just gives you a general idea of what's going to happen. They're also saying there's a higher chance that the Fed will cut rates by 50 basis points instead of the normal minimal 25 basis points at a lot of these meetings. We shall see. But it's interesting to look at. Bottom line is the market is pricing in and is factoring in that the market thinks, the bond market, stock market, whatever, especially the bond market we're talking about here, thinks that the Federal Reserve is going to start cutting rates sometime next spring. And they're not going to do anything between now and then as far as raising rates. So that's what everybody thinks. So that's where we're at. Let me show you the charts and how this has affected things. I did mention to you a minute ago that we had universal mortgage-backed securities up on Friday. As you can see, that's what happened. It broke through that 200-day moving average, which was acting as a ceiling to keep the price of the mortgage-backed securities down, which, of course, the price and the rate are inversely related. So the higher the price, the lower the rate and yield. But on Friday, it broke through that 200-day moving average. Today, it's giving back some of those gains, about half of them, but we're still above that 200-day moving average and a Fibonacci level right below that. So that is acting as a floor now instead of a ceiling resistance. It's acting as a floor of support. That's good news. We could see some general other improvements. So let's go to the title of this video. I say, okay, what are the two things you need to watch for this week that could cause mortgage rates to drop? Okay, here's what you need to watch for. So on Friday, that's the big BLS report. 2 days before that is the ADP report. ADP is a large payroll services company that covers a lot of different companies in the US. And they're so big, in fact, they have their own report that economists pay attention to and market news media pays attention to. And so this report they come out with on Wednesday every month only measures private payrolls. So it doesn't include the government, right? As far as government employees hiring and firing. The one on Friday, the BLS, does include government payrolls as well. And we saw a few months ago, the government hiring a huge number of people, and that kind of skewed the whole unemployment report. Now, traditionally, ADP and the BLS have not necessarily been aligned. Some months they have, but many months they're kind of far off of each other. And that's one of the reasons, right? The difference between government employees and private. So this Friday, if the BLS headline jobs report shows inflation, doesn't have anything to do with inflation. If it shows unemployment, the unemployment rate with a 4 handle, so 4% unemployment or 4.1, 4.2, whatever, and the number of new jobs created drops substantially or solidly at least below 200,000, you have two of those two things in place, that could very well cause interest rates to improve even more, and continue that momentum we've seen throughout November. As you see here, from the middle of October to now, we've had quite the run up in price. This has represented over 1% better mortgage rate. So long-term 15, 20, 30-year fixed mortgage rates are, about 1% better than they were towards the middle to end of October, just because of these moves in the market. So this could cause that momentum to continue for at least a few days, right? A period of time going into next week. But let's see what happens this week. So watch for those two things, that 4 handle on the unemployment rate and new job creations solidly less than 200,000. Should cause the needle to move and continue to show improvement in the long-term mortgage rates. Until then, have a wonderful week. If you're not following me yet on Instagram, please do. You can find me at The Bill Zimmerman, where I record a lot of different reels on mortgage and other related topics and housing related topics. And please subscribe to my channel so you can continue to get these updates and other videos as I post them. Have a wonderful week.